The recent decision by the Federal Reserve to lower the federal funds rate by a quarter percentage point to 4% has stirred quite a reaction in the stock markets. While many analysts anticipated this move, the real shocker lies in the Fed's perspective on the economy's current condition, as highlighted by the CEO of Quant data, Andrew Hiesinger. On Wednesday, stock markets initially surged following the announcement, but quickly reversed direction. The S&P 500 ended the day down by 0.1%. The Nasdaq fell by 0.33%, while the Dow Jones Industrial Average managed a slight increase of 0.57%. Interestingly, the Russell 2000, which tracks smaller companies, saw a modest rise of 0.26%. In the commodities market, gold prices experienced a brief spike to $3,704 an ounce, before settling back to $3,665. In the options market, there was a noticeable uptick in put options trading. These are contracts that allow investors to sell stocks at predetermined prices. This surge likely indicates that investors are seeking to hedge against potential downturns, according to Hiesinger. He pointed out that while the rate cut was anticipated, investors are now keenly watching for indications of whether the Fed might implement 2 or 3 additional cuts later this year, as well as the economic outlook for 2026. Hiesinger emphasized, the real surprise is what the Fed's opinion is on the current state of the economy. They're signaling some weakness in the future, which suggests they are preparing for more cuts. This perspective could be seen as encouraging for technology and growth stocks, which typically thrive in a low-interest rate environment. However, the underlying economic weaknesses, particularly in the job market, raise concerns for investors. For instance, the U.S. economy added only 22,000 jobs last month, a significant drop from the 79,000 jobs added in July, and the unemployment rate has climbed to 4.3%, the highest level since 2021. Neel Mukherjee, the chief investment officer at TIAA Wealth Management, noted that the Fed prioritized the deteriorating labor market conditions over inflation risks related to tariffs when deciding to cut rates by 25 basis points and projecting 2 more cuts this year. He described this move as a risk management strategy, indicating that the Fed is shifting from a restrictive policy stance towards a more neutral position due to increasing risks to the labor market. During the press conference following the announcement, Fed Chair Jerome Powell appeared less worried about inflation, especially in light of the economic slowdown and labor market challenges. Mukherjee commented, "This policy setup is bullish for bonds, bearish for the dollar, and neutral for equities in the short term." Jake Schurmeyer, a portfolio manager at Harbor Capital and a former member of the Federal Reserve Bank of New York's Markets Group, observed that the rally in small-cap stocks and the fluctuations in gold prices were logical outcomes given the new policy framework. He pointed out that the real surprise was not the rate cut itself, but rather the Fed's dot plot, which indicated a median expectation of 3 cuts, contrasting with the market's expectation of 2.5. This subtle shift towards a more dovish stance reflects a significant change in the committee members' policy outlook. Schurmeyer also noted that Moran's dissent was expected, but he anticipated that there could be 2 additional dissenting votes, highlighting the nuanced debates over policy and the uncertainty among Fed officials regarding the pace of future easing. He stressed that the Fed is maintaining flexibility in its outlook, and the data presented in the Fed's Summary of Economic Projections, SEP, should be viewed as fluid assessments rather than definitive commitments. As we look ahead, the upcoming Fortune Global Forum on October 26th to 27th, 2025 in Riyadh promises to be an exciting event where CEOs and global leaders will convene to discuss the future of business. If you're interested in attending, consider applying for an invitation.